Hello and welcome to Chapter 11. This chapter covers cost behavior. So what will change in your business? What kinds of costs will change as your operations change, as your volume increases or decreases, that sort of thing. It's a super beneficial thing to understand about business because it allows you to answer what if questions. What if our sales go up 10%? What if they go down 20%? What will be the impact of that? So I'll start out by talking about different kinds of cost behavior, fixed, variable, and mixed. Give you some examples of that. We'll talk about operating leverage. I'll talk about that actually later in the lecture. We'll talk about contribution margin income statements, which I think are very valuable. I use them in my business. We'll talk about break-even and target profit analysis, and then I'll end by talking about margin of safety. So first of all, cost behavior is defined as the way in which a cost changes as a related activity changes. So as we have more workers in our factory, we'll probably need more supervisors. As our production increases, we may need more forklift drivers. As our inventory increases, we may need more warehouse space, all of those kinds of things. So some activity is going to drive the costs that are associated with it. That makes sense. Everything we look at is across a relevant range, which means kind of a range of reasonable activity. If you think about St. Martin's University, a relevant range might be 1,000 students to 2,500 students, something like that, or about 1,800 right now. So that's a relevant range. So within that range, we can talk about how costs change. If we went beyond that, say if we said, well, what if St. Martin's had 10,000 students? Then what we consider fixed now might have to be increased. So again, knowing how costs are going to behave lets a manager predict an outcome. Say, if this happens, then X will be the result. So the first type of cost I want to talk about is variable cost. Those are costs that change in direct proportion to the change in some activity. So a good example of that would be raw materials or direct labor. If I'm making picnic tables and one of my raw materials is 2x6s, if I double the number of picnic tables I'm going to make, it will double the number of 2x6s that will be required. So the cost for lumber will double when production doubles. The same thing if I have someone in my factory that is cutting boards and sanding them, that kind of labor cost, if I double my production, that labor cost will double. So they're going to change in proportion to the volume or activity. So on a total basis, as production goes up, the total variable cost will go up. The variable cost per unit would stay the same. If I'm paying $2 a foot for lumber, that's going to be the same whether I'm making 1,000 picnic tables or 10,000 picnic tables. It doesn't matter. But the cost in total will go up in direct proportion to the amount of production I'm doing. On the opposite end of the spectrum are fixed costs. Fixed costs are costs that remain the same regardless of how much I make. So maybe, and again, this is where the relevant range comes into play. So again, in my picnic table factory, if I double the number of picnic tables, the rent for my factory is still, let's say, $10,000 a month. It's $10,000 a month, whether I make one picnic table or 1,000 picnic tables. It doesn't change. Same thing with my insurance for my building. The salary for the plant manager would probably be fixed. So there's a depreciation on equipment would be fixed. Those things aren't going to change as I change the volume. So in total, they're going to stay the same across all levels of production, again, within that relevant range. And on a per unit basis, they'll decrease per unit as I produce more because I'm spreading an equivalent amount of or a constant amount of cost over a larger and larger number of products. So some costs have elements of both, and they're called mixed cost. And in order to be able to deal with mixed cost or make accurate predictions, we need to break them into their variable and fixed components. Some people will call them semi-variable or semi-fixed cost. There's an example there about a rented machine. Another example might be electricity. So if you get an electric bill from Puget Sound Energy for your picnic table factory, if you have a month where maybe the month of July you decide everyone's going to take a vacation or we're going to close the factory down, you're still going to get a bill from Puget Sound Energy because you had a couple of lights on, you had the security system running, and maybe you kept the temperature in the building at 68 degrees or something like that. So you're going to get some level of electrical cost even when you have zero production. Now, of course, as you fire up all your machines and you got everything running and the vacuum system and all that kind of stuff, then your costs are going to go up. So a portion of your electrical bill is variable. It's tied to how much you're doing, how much electricity you're consuming if you produce more, and a portion of your electrical bill is fixed, stays the same. So in order to deal with mixed cost, we need to separate those two things apart from each other. And there's a couple of different ways we can do that. The simplest way is the high-low method. So to look at cost for several levels of production and take the high level of production, the costs associated with that, the low level of production, the costs associated with that, and then I can compare the difference in cost between those 2 points and the difference in the number of units produced between those 2 points. That basically, if you think about it in terms of a graph, it gives me the slope of the graph. That's the variable cost per unit. I can then plug that into an equation because total cost equal variable cost plus fixed cost. So I can rearrange that to get fixed cost by itself, and I can take the total cost for either of those 2 points and subtract the variable cost based on the cost per unit that I just calculated. That'll tell me what the fixed cost is, and I can use either the high point or the low point to do that. Then I can treat the variable portion along with my other variable cost and group the fixed portion with my other fixed costs. There's other ways to do that using Excel, but regression analysis, things like that, but this is the simplest method to do that. So once I have information about my variable cost, my fixed cost, and then I've split my mixed cost up, now I can start to do something called cost volume profit analysis. So now I can start looking at the relationship between my selling price for my product, the overall level of sales volume and production volume, and what's going to happen with expenses at different levels, which will produce different levels of profit. It can be useful if I'm trying to decide about what would be the impact of raising my price. Maybe I raise my price, but the volume goes down, but my sales revenue goes up. What impact will that have on my bottom line? How will costs change in those circumstances? I could have changes in cost. So I have friends that own restaurants, and when a new level of minimum wage gets implemented, they have to do this very activity to determine how much do I need to raise the menu items, the prices of the menu items in my restaurant, if I'm now paying more for a variety of different kinds of labor. So changes in cost, you can use this to determine what the impact is. Also changes in volume. What if my business grows by 20%? What will that do to my bottom line? And then determining a product mix. Most businesses don't sell just one product, and most products that they sell don't all have equal profitability. So what if my mix changes? What if people start buying more of product X instead of product Y? How will that impact me? One of the things to think about in terms of cost volume profit analysis is a term called contribution margin. So contribution margin is equal to my sales minus my variable cost. And I can either do that in total, as is shown here, or I can do it on a per unit basis. So in this case here, this company sells product for $20 a unit. Their variable cost is $12 per unit. So each unit contributes $8 towards covering their fixed cost and providing for income. I think that's a more beneficial way to think about what's left over after you sell something than the traditional cost of goods sold method. Most companies don't just have one product, so units don't necessarily make sense for a lot of companies. So in that case, we could do it as a percentage. We could calculate a contribution margin ratio where we divide the contribution margin by the sales. That'll allow us to say, a change in income from operations is going to be equal to how much my sales increase times that contribution margin ratio. So here's something I think is really beneficial, and I used to do this in my company for internal financial reporting. So on the left side, I have a traditional format income statement. Okay, sales minus cost of goods sold equals gross profit minus selling and admin expense equals net income. In the contribution margin format, again, this is only appropriate for internal reporting, not external. I can take that cost of goods sold figure of 400,000 and I can break it into the variable portion and the fixed portion. So I've got variable manufacturing expenses of 300,000 in this example. That might be direct material, it might be direct labor, and there might be some overhead items like maybe grease for the machines or the portion of the electricity that's variable in the factory. That would be all included there. And then down below in fixed expenses, I have the fixed portion, the other 100,000. Maybe that's the plant manager's salary and rent for the factory and depreciation. Then I look at my selling and admin expense. I also had 400,000 of that. I can split that into its fixed and variable portions. So a common variable selling administrative expense would be sales commissions paid to salespeople. So in this case, I have variable selling and admin of 50,000, and the other 350 is fixed. It's the president's salary, the office rent, those kinds of things. So now I can see the same bottom line. This isn't like having two sets of books. It's just using a different method to portray the same transactions. So I have $1 million in sales. I have 350,000 in variable costs. That gives me a contribution margin of 650,000 or 65% of $1 million. My fixed expenses are 450,000, which gives me net income of 200,000. The benefit here is I could say, what would happen if sales went up by $100,000? Well, my variable costs would go up, okay? And in this case, those would go up by $35,000, 35% of the 100,000 in gain. And my contribution margin would go up by $65,000, so it would go up to 715. Okay, it would be 65% of 1.1 million. My fixed expenses wouldn't change; they would stay at 450. So I know from just looking at this format that my net income would go from 200,000 to 265 if my sales went up to 1.1 million. Likewise, I can say, what if sales go down to 800,000? In that case, I would lose $130,000 on the bottom line. I would have a net income of 70,000. So this is a really useful format for intuitively seeing how are changes in volume going to affect our bottom line. Another thing we can do with this is calculate a break-even point. That's the point at which profits equal zero. So I take my fixed costs and I divide by unit contribution margin. That will tell me how many units I have to sell in order to have a profit of zero, break even. If a company is losing money, they want to calculate this break even to know, is it reasonable to think we can increase our volume to that level to stop these losses? So the example here is I have fixed cost of 90,000. I have a selling price of 25 and a unit variable cost of 15. So each unit I sell is going to give me a $10 bill. So my question is, how many $10 bills do I need to collect to cover that $90,000? In this example, it's 9,000 units. And again, a lot of companies don't just have one unit like that. So another way to do it is to use the contribution margin ratio. So I can calculate my break-even sales in dollars by dividing the fixed cost by the contribution margin ratio, the percentage of contribution margin to sales. So in this case, my contribution margin ratio is 40%. So at what level of sales would 40% offset $90,000? It would be the level of 225,000 in sales. So if this company is selling 200,000 a year, they know that they have to sell 25,000 more to get to a point where their losses stop. Now, related to that is target profit, because most companies don't aspire to break even. They want to earn some money. So I can modify this slightly by adding target profit to fixed costs. So now I'm saying, how many units do I need to sell so I not only cover fixed costs, but I also achieve that target profit that I'm shooting for. So in this example, I have fixed cost of $200,000. I want to earn $100,000 in profit. I have a product that sells for $75, cost of $45, contribution margin then is $30. So how many units do I need to sell where each one gives me $30? That would cover the $200,000 in fixed costs and give me $100,000 in profit. You can see from the formula there, that's 10,000 units I need to reach for that to happen. So operating leverage is a way of saying, depending upon a company's mix of fixed cost and variable cost, what would a change in income result from how their sales change? So companies that have high variable costs and low fixed costs, they have low operating leverage, meaning a big increase in sales is not going to give them a big increase in income because the majority of it is going to go out as variable costs, which increases volume goes up. Companies that have outsourced a lot of their production, where most of their costs are variable, are in that position. Companies that have low variable costs and high fixed costs, meaning they own their own factories, they own their own machinery, so they have a lot of fixed costs, their variable costs are lower, they have high operating leverage, meaning if their sales go up, quite a bit of that flows through to the bottom line because there aren't much in the way of variable cost. So the formula for that is I can take a percentage change in income, that's going to equal the percentage change in sales times the operating leverage. I'll be able to determine that. The last item is margin of safety, and that just tells us how far are we above the break-even point? How much could our sales fall and have us still earn a profit? So the margin of safety is equal to whatever our actual sales are minus our sales at the break-even point. We could calculate that in units, so that could be sales minus the sales at break-even point divided by the unit selling price. That if we sell 10,000 units and our break-even is 9,000, our margin of safety is 10,000 or 1,000 units. And I could also do that based on sales as a percentage. That would tell me what percent could my sales fall and have me still break even. So that's the end of the lecture for Chapter 11. I look forward to talking to you when I record the lecture for Chapter 12. Thanks.